Big global events are grabbing headlines, but what if geopolitics goes temporarily quiet? What's really driving the gold and silver price right now? Stay with us. It's the Real Money Show. My name is Jeremy Wiseman. I'm joined by Jerry Correia. The number 18778-SILVER and the website guildhallwealth.com. Today, we have a very special guest joining us on the Real Money Show from Arcadia Economics on YouTube. The goldandsilverdaily.substack.com is where you're going to find his information. It's Chris Marcus. We're so happy to have him on the show. We think you're really going to enjoy some of the questions that Jerry's got. So, hey, Jerry, we've got him on the line. Let's get straight to it.
This week on The Real Money Show, we welcome Chris Marcus, founder of Arcadia Economics and a leading voice in the world of precious metals with over a decade on Wall Street, including stints at Moody's and Susquehanna International Group. Chris left the mainstream finance world after the '08 crisis and crash, which opened his eyes to the system's deeper flaws. Now, Chris is on a mission to help everyday people understand what's really happening behind the headlines and how to prepare before it's too late. He believes we're on the edge of a historic financial shift, one that could reshape markets just as the 2008 crisis did, only more dramatically. As the author of The Big Silver Short and a respected commentator on his very own Gold and Silver Daily.substack.com, Chris brings insider insight to the growing movement of Canadians looking to protect their wealth with real assets. Chris, we are excited to have you join us. Welcome to The Real Money Show.
Sure. Well, first of all, thank you so much for having me here. I appreciate being with you guys. Always fun to talk with you about what's going on because, as you point out, we're in a bit of a different environment than 20 or 30 years ago when you would hear gold and silver investors say, hey, well, one day this debt could get out of control and the Fed might get out of control. I think we've exited that stage and we've moved on to a new one, which you could say really that perhaps if you want to put a starting point on that, is what happened when Russia got kicked out of the SWIFT system in 2022. And that's really when central banks, it was direct correlation. That's when the central banks started setting records of the amount of gold they've purchased. And, now it seems like we're getting to the point where it's one thing to say, well, hey, the debt dynamics here don't look good from a long-term perspective. But when you cross over and it starts to become a non-functional relationship, especially for oil producers that are digging the oil out of the ground, but if they used to store it in treasuries, but now your treasuries 5 or 10 years from now are going to buy you back less oil than they previously did, amongst many other factors that are happening in the treasury market. Not only does it seem like we're entering this phase where now there's an actual problem from an investment standpoint, aside from speculating about the future, but also we're seeing this shift take place now, and that's even before you've seen some of the things that some of the BRICS have been discussing put into action. But, you're seeing the shift now, and it's, on one hand, fascinating to see something like this take place, certainly alarming in certain ways too, but I think we're into a new phase of this.
Oh, yeah, and look how quickly it came right after the Russian-Ukraine involvement with each other. We had the de-dollarization, all undigitizing away from the SWIFT system, the creation of the BRICS and the MPay, and even now where we're seeing Goldman Sachs comment on the 60-40 portfolio split, 60% stocks and 40% bonds. That's now dead. Look how quickly that has happened, and it's definitely echoing this dramatic shift that we're seeing, both with currencies, with banking, with financials, and the global monetary system. So shifts are underway, and it's definitely something that we have to be very cognizant of and trust to just down the drain. Going forward to the second question here, the debt spiral that we're seeing. The U.S. just crossed $37 trillion. The U.S. is sitting at a U.S. debt to GDP ratio of 122%. It's well above the 1980 and even the debt ceiling panic of 2011. Where is that debt ceiling? Yet gold, relative to the size of this crisis, still looks undervalued. Why do you think that disconnect exists? And And secondly, what does it signal about how far we are into this monetary mess and monetary reset?
Well, I guess that all depends. Certainly, you can say if you're looking at how much money is actually out there and where the gold price is, I think you could make a case that it's low relative to that. Or perhaps if you take that a step further and think about, with all these dynamics going on between the U.S. and China, trade imbalances, and the increasing role gold is taking on, what price would it have to be at to have something that balances this out a bit more? I think that would also be a bit higher. At the same time, we are also at record all-time highs, and so I think that's a telling statement in and of itself. But it's funny, right before we started our call, I was finishing a section of a silver report that I'm putting out, and I noted how in June 12 of 2024, former Secretary Janet Yellen said, I think if the debt is stabilized relative to the size of the economy, that we're in a reasonable place, which sounds lovely, except for the fact that right underneath that, I found a chart since back in the 1960s where you can see that debt as a percentage of GDP is climbing. And also worth noting that 6 months later, after Janet said that, she was in front of Congress saying, I'm sorry we haven't made more progress on the debt. I believe the debt needs to be brought down, especially now that we're in an environment of higher interest rates. So it's kind of like you have the perfect storm has been building for 30 or 50 or 100 years, and now we're getting into the later innings. And as you mentioned before, do the gold and silver prices always go up on a one-to-one basis based on the news that comes out or the headlines that come out? No, and you could probably make a case that no market is that efficient, yet you look at what's happening and you look at the response in the last year and a half, and I also don't think that's an accident. And perhaps the last part to add on to that, if you look at, okay, what are we facing now and what choices do that leave investors, I think there's a good case to be made that not only is this not over, but it's also possible we could be in the early innings.
Mm-hmm. Yeah, I couldn't agree more. And, with regards to where we're headed, obviously unprecedented times, but I think this is what gold and silver offer, is some solace and in history, knowing that we have had times to rebalance and reshuffle. We think of the gold standard removal, the revaluation of the gold price. And this has happened before, and it gives us some confidence and some hope at the light at the end of the tunnel that you do have gold to come in and, I guess, buffer the asset side of one's balance sheets that have now exceeded 122% of debt to GDP ratio. So as we progress into this monetary reset, it's I think you're absolutely right. It's definitely time to very important to keep an eye on the gold and silver prices during these resets. And now, thirdly, looking at the ratio, something that also goes back and is very historic, goes back hundreds of years. The silver to gold ratio. We talk about this at length on the show. We're seeing silver now well supported above 35, and right now we're in about mid 36, 36.50, and that gold to silver to ratio is still up near 90 to 1. Now it's crashed down towards 90 to 1, but it's historically out of whack. Are we starting to see the early signs of that ratio breaking down? And what does history tell us about what happens when that spread starts to close, and why does it matter now more than ever, Chris? 3 questions for you, Chris.
Well, there's a complex question with a couple of parts, because, yes, when you go further back, especially if you look, I think, from 1700 to 1900, it's really the period before the Fed came along. It sat there around 15 or 16 to 1 for, I believe, more than a century. So that has been the long-term history. With that said, I would offer this warning to people who are, I don't disagree that you have a good case for the ratio to come down, especially I believe the mining production ratio was about 6.5 to 1. So about 6.5 more times silver produced than gold. So, yes, there's a case to be made. Also, I would point out, though, that the gold to silver ratio has been elevated for a couple of decades. So will that happen tomorrow? Probably not. If someone has a long enough time horizon, is there a case to be made that it will correct? I think you could do that, although I guess one thing that I would just factor in there is that for those who are of the school of thought that at some point this money that has been spent, and in my opinion is mathematically impossible to be repaid despite what Treasury Secretary Bessent is saying right now, if you believe that somehow there's going to have to be some sort of gold monetization invoked into this, and I say this as a big silver advocate, I do think that we're more likely to see that if there was a monetary backing added, that it would be more likely to be gold rather than gold and silver for two primary reasons, in that if you want to basically be able to adjust the gold price and use that to pay off debt, with silver, you have to factor in that aside from Russia, who announced that they're going to start buying silver and adding to that to their reserves, most governments don't have any silver. Most banks don't have any silver. So it's not actually wiping out debt. And also the second part, and I give Luke Groman, a fantastic macro analyst, credit for this, to get enough to the silver price that you would have to raise it to make a meaningful contribution to the debt, especially because there's so little of it. You know, if you raise the value of the silver market by, you double it by another $35 billion, that's still a drop in the bucket. And you would have to raise the price so high that basically it would eliminate any industrial use, because, we could debate what number that point is, but if you have a $500 silver price, there's going to be some applications where it's like, hey, this doesn't make economic sense anymore. So yes, I think there's a lot that can be gleaned from the gold to silver ratio, although there are also circumstances or situations rather where, for example, let's say that there was one day a higher gold price used to wipe out debt. You could also have a situation where that ratio could actually increase. And I offer that caution just because we're entering an environment where perhaps more than ever, yes, there's some trends, and I think with what's happening with gold and for the reasons why it's happening, there's certain parts you can see, although, theoretically, we're all expecting in some sense that we're entering what could be the most volatile, unprecedented set of circumstances if you have the nation that is running the world's reserve currency run into trouble, that there's also a lot of different ways it can go. So hopefully that just puts some context around a few things to consider in terms of looking at the gold to silver ratio.
No, I agree. Totally. You make a whole lot of sense. And you highlighted a paradox, with regards to the silver price and its usages in an industry. Yeah, and I kind of side with you with the fact that, we can see a financial system being backed by gold and silver being reintroduced for usage for commerce. We're seeing this in the state that you live in Florida, just this past few weeks, and then the developments now that we are seeing people with the ability to now utilize, gold and silver coins without sales tax for the purpose of commerce. These are very refreshing things to witness. We are following these trends. And no, thank you for weighing in your opinion and all of these facts. Another notch in your credit. So I appreciate that answer.
We're going to take a little pause for just a moment. We've got to get to some commercials. But first, if you're looking to get involved in the physical gold and silver market, the number 18778-SILVER, the website, guildhallwealth.com. That's to get physical gold and silver, whether you're buying it direct, storing it in a vault for ease of liquidity, or having it as part of a retirement portfolio like a registered account, where it's fully allocated, fully segregated, held outside the banking system, no counterparty risk. That's what we focus on here at Guildhall Wealth. More to come with the interview with Chris Marcus, so stick with us here on The Real Money Show on 640 Toronto. Welcome back to The Real Money Show. The number 18778 Silver, the website guildhallwealth.com. That's to learn about holding physical gold and silver in your portfolio. Not just any physical gold and silver. This is LBMA approved, highest quality product, most liquid product in the world, held in a vault outside the banking system. This is making sure that your product is not going to be touched by anybody else, that there's no counterparty risk. This is the safest way to have physical gold and silver as part of your portfolio. Let's get back to Chris, who's on the line with us.
Chris, back in November of last year, 2024, you pointed out something really insightful. You said that the markets might have a different perspective on where the tariff policy leaves the US dollar valuation after the initial excitement had wore off. And sure enough, that's exactly what's happened. Now, even while the Fed is on pause, the dollar index is flashing weakness. The dollar index is at 3-year lows. The Fed's on pause. Other central banks like the European Central Bank, Swiss National Bank are actually cutting rates. The US dollar is dropping fast to the lowest since 2022. That's not happen. That it's not supposed to happen under traditional thinking. Now we're watching that trend continue with rate cuts likely just around the corner, especially with President Trump likely to appoint a more dovish Fed chair. Can you break down why the dollar's weakness, even without immediate Fed action, is so telling, and what it signals for gold and silver prices going forward?
Well,
great call, by the way.
Point you mentioned. Well, thank you. And I guess what I was thinking about back then was, hey, if you look at what happened to the dollar index in the 2016 and 2017 when Trump was elected the first time, you saw a similar pattern to what we just witnessed over the past 6 months, where I believe it was around 95 when he was elected, shot up to over 103 by January of 2017. And then a year later, it was under 90. And similarly, when he was announcing that the policy is just going to be to tariff everyone, I mean, I think there's situations in which that makes a lot of sense, but the context, especially in financial markets, is always important. And when you factor in basically everything we've talked about for the first 10 or 15 minutes, okay, you can have the dollar rally and people get excited that, oh, this is going to be a strong dollar policy, yet I think we saw a lot of chaos and volatility over the first couple of months. And sure enough, as it's like, one of those things that governments say that, oh, that sounds great, but like actually implementing it doesn't often quite go as simply and smoothly as they sell it initially. And certainly that's been the case here. And yeah, like you mentioned, it's pretty stunning that we're seeing this happen even while the Fed last week, they said in their dot plot, well, we're expecting 2 less rate cuts in the next 2 years than previously expected. And like you also pointed out, I mean, we just saw the Swiss National Bank take rates to 0. ECB, I think, what is it? They've had eight consecutive cuts now, I believe. So, and the dollar index is falling even while the spread is going in its favor. So, perhaps maybe the other caveat to add to that is that also shouldn't be a big surprise because even before Trump was elected, we heard J.D. Vance talk about, well, what was the phrase he used? He's like, oh, yeah, dollar devaluation. He said something like, it sounds like a bad phrase, but it's really just making exports go in our favor. We've seen multiple Trump officials talk about, say, the overvalued dollar, or we even had Stephen Moran, who people may not be as familiar with him, but he's the chairman of Trump's Council of Economic Advisors. He wrote a paper in November of 2024, which he called The Hand Guide to Restructuring the Global Trading System, where he referred to the overvalued dollar. He even said it is the root of all economic imbalance at one point, and throughout 41 pages, he mentioned ad nauseum the problems that are stemming from the overvalued dollar. And okay, then a month later, after he writes this paper, Trump names him as his chairman for the council. And now here we are a couple months after that. And like you pointed out, well, if Powell's not going to cut rates, and we know Trump's getting ready to pick his next Fed chair, I mean, it seems like a pretty darn good bet that whoever he picks is going to be in favor of cutting rates. I secretly hope we could get a reemergence of Ben Bernanke. I think that would be fun, and then could make more helicopter jokes. But maybe that is starting to come through. And I think when you have things like 2 weeks ago, Mohammed El-Arian, very well-known bond investor who formerly worked at PIMCO with the bond king Bill Gross, he's even tweeting out, markets aren't looking at the Treasury as a safe haven. He actually said gold and silver instead of the Treasuries. This isn't a gold bug or a gold dealer or, some sound money advocate. These are the people who used to think all of those gold investors were the nutty ones. And now you're seeing the mainstream investors turn their back on the market that has been the bedrock of their career. I don't think it's an accident that that's happening. I think it's becoming more apparent where this is heading. And when you hear Janet say the things she does, and you hear one Treasury secretary after another or Fed chair after another, and the same thing, and ultimately one day you get to the point where even the mainstream investors are saying, hey, this Treasury doesn't make sense anymore, and I'm reallocating to gold and silver, and we're seeing that happen now.
A huge trend that we're definitely following. And, regarding the, Besant and that comment, I think there's, me personally, there is definitely reasons why you would want to have a weaker dollar, but at the same time, you want to balance it with a credible dollar at the same time. It's boosting the credibility while devaluing at the same time. We know that the U.S. has about $9 trillion in debt that needs to be renewed, and they cannot renew at these lower rates. So I think the market is now pricing in many more slashes. The Feds, as you mentioned, they're on pause at 4.5%. There's a lot of room on the downside. And if we look at the Swiss National Bank hitting zero, if we head back to zero, I think just looking at gold and silver make a lot of sense, simply because they are inversely correlated to a weaker U.S. dollar. So I think would you agree that if you can wrap up the segment with everything that we've discussed to the importance of holding physical precious metals. As you know, Chris, we've been doing this since 2002 and offering Canadians and Americans the ability to hold physical precious metals outside the banking system, whether it be in a precious metals IRA or a precious metals RSP. Could you wrap up and just, I guess, in your own words, tie it all three in the importance of holding physical precious metals today?
Well, perhaps the best way of summarizing that is if you go back 2 years before you guys started, maybe back to the year 2000 when gold was $260. And it's funny, a couple months ago I was thinking, gold is 10x since then. And now here we are at 3,400. I realized, wait, we've added a couple more X's. So perhaps or you can go further back to when the gold price was $35 on the Bretton Woods system. And then I would suggest that the reasons that have driven us from there to here, as we just discussed, they could be even more pronounced then than they were back in 2000. Keep in mind that, we also said sometimes the pricing and the events isn't linear, but maybe even a better example on the silver side here where, the silver price does go below the cost of production at brief times here, but that's where the inflation drives this up because it's getting a lot more expensive to mine for any of these things. And when you see inflation up 9%, even according to the CPI a few years ago, mining a very capital intensive business. And so you're probably not going to have miners paying to dig money out of the ground at a loss for too long. And unless you know of something that's actually cheaper now than it was 20 years ago, I would say you can expect that the cost of mining is also going to be rising, which will serve as a floor for investors. And again, you could just look at the actions. Japan, about a month ago, previously said, well, we won't look at using our treasury position as leverage in a trade deal. Then they changed that. China doesn't seem like they're going to be in a rush to go fund the U.S. debt load. And geez, like you mentioned, we even have the states talking about the same thing. So makes you wonder who's going to be in a rush to buy an accelerating issuance of Treasury at a time when the value of it's going down and when the dollar is going down. And perhaps the last thing I'll mention that you touched on in there is that there's a difference between the dollar going a lot lower and the dollar not being the reserve currency. And I think it's still very much their plan to maintain the dollar as the reserve currency, but at a level that's going to be a lot different. And unfortunately for just about everyone, will be giving you less purchasing power parity. So you will see that devaluation. But I imagine that they are going to do what is possible to have it retain its reserve currency status, and hopefully the distinction between those two makes sense. As I think it is an important one.
Amazing. Well, Chris, thank you for joining us today on The Real Money Show. Chris Marcus from Arcadia Economics, your insight and ability, seriously, to cut through the noise, highlight the deeper financial trends is incredibly, incredibly valuable, especially for our listeners looking to not just survive but thrive during this massive and ongoing wealth transfer. Before we let you go, we know you mentioned earlier, a highly anticipated market report dropping any day now. Can you give our audience a sneak peek, some key takeaways, or as I call it, silver nuggets they should be watching for, and let them know how they can access the full report and follow your work?
Yeah, well, thanks for mentioning that. I've actually been writing a silver report. Ended up being a little bit longer than expected, but finishing up some editing now. Probably be another week or two before it's available. Although, really what I wanted to touch on in the report was, A, what's happened that got us to this point, B, what we're looking at now, and then C, some of the different paths that this could evolve down, and as well as answering some of the questions that I think a lot of silver investors have had, such as, okay, well, we had this decade of quantitative easing and 0% interest rates, yet the silver price got clobbered during that. Or we saw 9% inflation in 2022, yet the silver price was dropping below $18. So a lot of these different things that I don't hear answered too often, but I think would give people a great context to understand, especially what's going on in silver. Of course, we touch on gold quite a bit too. And I guess the best way to be posted when that is released, we do have a Substack at goldandsilverdaily.substack.com. You can sign up for free there. There also is a $10 a month service where you get a daily posting. But either on the free or the paid one, if you sign up there, you'll get a notification when that report is out. And Jerry and Jeremy, I'll look forward to sharing it with you guys as well. And hopefully it'll help put everything in context, not with a perspective of, you need to go out and buy or do this or that, but just giving people the information that is helpful so that they can feel confident understanding what's going on and then making the best, most appropriate decisions for them.
Exactly. We appreciate the work. And Real Money Show listeners will post all the links on our YouTube channel, our X feed, and social media. But go directly and subscribe to Chris Marcus's goldandsilverdaily.substack.com. Chris, thanks again for being with us. We look forward to having you back on soon. And I said soon, you got to be back with us very soon. Okay, Chris?
Well, I sure appreciate that and appreciate the chance to talk to your audience. Hope everyone who's listening at home is doing well out there, especially in some chaotic times in the world, but we prepare as best we can, and hopefully this was helpful.
Thank you so much.
Welcome back to The Real Money Show, the number 18778-SILVER, and the website guildhallwealth.com. Again, stunning interview with Chris Marcus. I really, really enjoyed that. Just sat back. And I listen to a lot of interviews every day. And Jerry, honestly, great job there. Let's talk about what we're going to get to right off the bat. We talked and said that the headlines are changing. What happens when geopolitical risks sort of seem to fall out of favor in a way? What's driving the price of gold? And I believe that, gold isn't always driven just by pure events. It's a process, day to day, what's going on in the markets. And I think that is still always happening and always has been happening behind the headlines.
Correct.
So I wanted to quickly go through this report that Vince Lancy was that put out recently, because he was basically saying economic data set to replace geopolitics as the primary gold driver. Give us a sense of what this article is about.
Well, it was his gold and silver outlook for the rest of 2025. So we're going to put that up on our Twitter feed and our newsletter. But predominantly what he reports is that the gold's ascent towards 33, 34, 3,500 this year has been primarily driven by global trade, tariffs, uncertainty. But now we're shifting back towards the other driver, which would be macroeconomic data, becoming the primary catalyst for price movements. And definitely, something is definitely telling me that what we're seeing right now in the gold market and the consolidation is almost over. Gold has been consolidating recently. But the main driver of gold now is inflation, is Fed policy, interest rate cuts, not Iran, not tariffs, and we don't have a ceasefire with inflation. That's the problem.
And I also want to note that in this particular piece, he mentions that Goldman Sachs is standing firm on their call for $4,000 for gold this year, despite the bear call by Citigroup last week that we discussed.
Right.
And also that Bank of America is also staying firm with a call for $40 silver in 2025. So again, a lot of these geopolitical issues, I think it goes to what you discussed in your interview with Chris Marcus, this idea that you don't need to print more money to make the dollar go down in value. I think at the end of the day, what I was taking away from listening to Chris is that it's already, the damage is done. The money's been printed. The debt is there. The U.S. dollar needs to lose value over time because those things have already happened.
Yes.
Would you say that that's an accurate interpretation?
I do believe it's very accurate, and that is it. The U.S. will work to maintain the credibility of the U.S. dollar by supporting the Treasury in some way, shape, or form, likely gold and their stablecoin research. But this is going to be the reason why Canadians and Americans need to really protect against the devaluation of the currency. You're not going to get away from inflation. And part of Vince Lancy's report was this shifting toward the macroeconomic fallout. Slower growth, rising inflation, this dynamic increases the probability and likelihood of stagflation. This supports gold and silver as a risk hedge. So that, to me, going forward was the main point for not just Americans, but Canadians as well. We are anticipating weaker and weaker currencies. The Canadian dollar has lost over 97% of its purchasing power since 1913. There's no way to turn that around.
And they could go further down. Moving into this next segment, Jerry, the Globe and Mail had an opinion piece. It's titled, Canada, Prepare for a Decade of Thrift and Lower Living Standards. I mean, talk about predicting the past. We're already there. Tell us something we don't already know.
And what's with the euphemism saying thrift? Yeah, we love thrift. We love thrift shopping, but not when it comes to cutting our lives.
But look, in the next segment, let's talk about what we're actually seeing in Canada on the ground that's telling us that, yeah, you should prepare for this because the leadership is bringing you in that direction. At the same time, how are you going to protect against that? And obviously, you know where this is going. You're a listener of The Real Money Show. How has gold and silver protected against that so far, and what are the expectations moving forward? If you want to hold physical gold and silver as part of your portfolio, consider learning about it today. Consider making that step today. Go to guildhallwealth.com and we will show you step by step how to hold physical gold and silver and make that change from letting other people tell you where to put your money to you being in control of where you put your money. And gold and silver have been money for thousands of years. They are an amazing place to store value. They've done that for 20 years plus. They will continue to do that through all of these changes that we're discussing. It's guildhallwealth.com. We truly believe in the value of holding physical gold and silver. We've already seen great results, but we do believe that they are still incredibly undervalued against the debts, against potentially more money printing or currency printing. And there's every reason to have a finite asset like physical gold and silver, especially in a registered account where it's allocated, segregated, and outside the banking system where it's stored so that you have no counterparty risk. That's especially important in these times that are quite risky and volatile. Now, Jerry, I want to turn our attention to Canada. Carney was in Europe. He seems to be making all of these deals with the European Union, which, by the way, the euro has been surpassed as the second largest asset in central banks' holdings. It's now gold. Here we are making deals on euros. But what I noticed that's missing from all of these pressers of this prime minister is there's no deals. There's promises. Unless you're spending money, there's lots of spending, right? We commit to spending billions and billions of dollars to NATO. We commit to spending billions of dollars on Ukraine. We're going to blackmail the Toronto City Council on turning houses into units, smaller units, and studio apartments aren't even selling in this city. So it doesn't make any sense. But there's no deals. There's no deals being made. There's just money being spent. This is demoralizing, in my opinion, because you're not getting a sense of, well, where's the money coming from? How are you going to earn the income? Where is the economic prosperity that's going to pay for all of this spending that you're doing? You know, someone made a note. Chrystia Freeland wouldn't even give a budget last year, 8 months ago, because she said, we don't have enough. And now they're just like, well, it's probably worse than that, so we just won't give it. Mm-hmm. What do you make of this?
No deals for us, the people. It's all for their own special interests. And look at this one here. Do you feel your wages, listeners, do you feel your wages are outpacing inflation? Well, CTV News thinks it is. Canadian average wages apparently is outpacing inflation, says Stats Canada. I mean, how much more Canadians, how much more can you take of this gaslighting to know that they're now rejigging the numbers? Their Stats Canada wages are not outpacing inflation. In fact, we know that Canada is shortchanging our seniors. It is true. If a nation that does not take care of its senior citizens is not a nation at all. If we use the 1979 inflation math, old age security would be higher. They've substituted beef instead of chicken. You go to these type of meats. All of these reshuffling and rebalancing the scales is not doing anyone a disservice except themselves. Canadians, now is a time to wake up. In the interview, we learned that the 60-40 portfolio is dead. Stagflation is here, and the only way to protect your wealth is with gold and silver. Stagflation is very bad for your portfolio, especially in stocks, especially with currencies, but it's great with gold and silver. This is the big takeaway, the message for us Canadians.
And look, gold last year was up 37% in Canadian dollars. This year, it's up 21% in Canadian dollars. Last year, silver was up over 30% in Canadian dollars, and this year we're up just under 20% in Canadian dollars. The markets are on the move. The reasons are not just geopolitical, but they're also economic. This trend is set to continue, and it's important in our minds to have an insurance policy for your portfolio and have something that's negatively correlated to the dollar if the answer to all of these spending issues is going to be print more money, get more debt. How else are we going to pay for all of this? And that is a spiral to nowhere. So you have to protect yourself, and you can gain in this environment as well. So it doesn't have to be all doom and gloom. There is opportunity at the end of the road here, and we believe that that's going to come in the form of physical gold and physical silver. And don't believe us, central banks are doing it too. Jerry, great interview. Great to chat with you. Thank you to everyone who's joined us this week to listen to The Real Money Show. If you've missed an episode, catch us on YouTube, catch us on Rumble or even Spotify, and follow us on X. We'd love to have you join the community and tell us what you're thinking. And that's it. That's another episode of The Real Money Show. The number, 1-877-8-SILVER, the website, guildhallwealth.com. Can't wait to speak to you next week here on The Real Money Show on 640 Toronto.